10 years ago, our flagship fund, the Global Flexible Fund, kicked off. And today it has generated inflation plus 10% per annum over that period. Now, of course, it has had the tailwind of a bull market in South African assets over that period, but it has also had our philosophy and process to drive it forward. So our investment philosophy is that of a value investor. We like to buy cheap assets, but with an emphasis on good quality assets. And when we say good quality, we mean assets with barriers to entry that prevent competition from eroding their margins or their high returns on capital. So we like buying undervalued, good quality assets. Our investment process tells you how we do that. And there's three elements to the process. The first element is idea generation. Where do we get our investment ideas? Generally, when we see a crowd running away from something, that is where our investment ideas, they lie in the area where the crowd is running away from. So when there's lots of fear, lots of negative news, that is generally where investment ideas, cheap assets lie. Assets do not get cheap when there's a cheery consensus. Assets get cheap when there's fear and negativity. That's why we invest or have historically invested in places like Greece and France and Italy and Portugal in our global fund. And today in our equity fund, South African equity fund, we're investing in platinum shares, which are good quality businesses, but are suffering from labor problems, governmental interference problems, and also a cyclical downdraft in commodity prices. So it's almost like a trifecta that's hitting them. This has caused them to be priced at levels that we think is far below the intrinsic value. I think a question that comes up when people discuss value investors very often is, what do they give up when they get involved in short-term losing positions like Amplats and Implats and Lonmin, and when they don't own at the time what is doing well, like today SA Breweries or BAT or Rembrandt? We did some numbers in 1998 on buying Impala and shorting or selling Dimension Data. Remember, this was 2 years before the peak of the IT bubble, so very early on, shorting Dimension Data and buying Impala Platinum. Now, in the 2 years leading up to March 2000, in other words, the 2 years leading up to the peak of the IT bubble, if you had put that trade on, you would have lost, and I think the number was about 70% of your money. You only would have had, by March 2000, 30% of your money left. 4 years later, by 2004, you would have made 80 times your original investment. So bad was the downdraft in Dimension Data share price, whereas Impala's share price started going up. And I think that's the key, is that yes, there is a short-term relative performance price one pays by being a value investor, because generally we tend to be early. But longer term, the one who wins in investing is the one who loses the least. So if our positions don't perform as well as some of the higher flyers, when the market turns down, which inevitably does, every cycle it turns down, every 5 to 7 years of the downdraft in the market, we lose a lot less money. So we make less on the upswing and we lose less on the downswing, and you put those two periods together and we come out ahead, and that is what our historic numbers have shown.